Business News segment is brought to you by
Hello, good evening to you. Welcome to the Business News here on News 360. My name is Alfred Okansi. Let's go into our first story. This evening, a senior economics lecturer at the University of Ghana is lamenting that government's crave for domestic bonds is starving the private sector of needed funds. This comes after government accepted more than 811 million cedis worth of bids for a 5-year domestic bond and will pay a yield of 24.5% on June 23.
The 24.5% yield paid on the 5-year bond represents a 0.7% decrease on March's 24.75% yield paid on the similar 5-year bond. Foreign investors accounted for 61% of, which was arranged by book builders comprising Barclays Bank Ghana, Stanbic Bank, and Strategic African Securities. Government plans to issue a total of 16.83 billion cedis in short and medium-term domestic securities in the third quarter of 2016. Of this amount, 14.91 billion cedis would be used to roll over maturing debt. According to a senior economics lecturer at the University of Ghana, Dr. Ebuteksen, government must be cautious with its debt management strategy.
When a debt to GDP ratio is increasing, investors tend to have this apprehension and still giving their money to you because then the debt is getting to a level that is considered to be unsustainable. The private sector has been crowded out of the credit market, and it looks like this government is not listening. And they also have their expenditures to meet, and therefore they are looking for domestic sources of income to meet their expenditure. The private sector is continuously being crowded out with high interest rates.
The International Monetary Fund's new fiscal monitor report is projecting Ghana will end the year with a debt to GDP ratio of 74.1%.
Let's stay with finance, but the biggest news item over the past week was Britain voting to cancel its membership to the European Union. The British pound dropped to a level not seen in almost 30 years. Stocks on the London Stock Exchange and also exchanges across the globe were not spared. But considering Africa's relationship with the EU, how is it likely to impact on trade and investments on the continent? Let's find out more.
The one obvious channel through which Brexit could affect economies in Africa is if it triggers a recession in the United Kingdom. Combining data from the UK's Office for National Statistics in the United Nations Conference on Trade and Development for 2014, the latest year for which we have comparable data, exports from Africa to the UK represent about 5% of Africa's total exports. Africa is more worried about a slowdown in China, its biggest trading partner by far. What about foreign direct investments? For 2014, total FDI flows from the UK to African economies were about 16% of total flows to the continent. In terms of the stock of FDI, which is a measure of the total value of investments in Africa, the UK's portion was 8% in 2014. Renowned economist Professor Jeffrey Sachs believes this could hurt Africa.
I think the aid budget is likely to be cut, and in general, there's going to be a lot of negotiation in the next year or two simply within Britain, so I don't know if they're going to have much attention for important issues of development in Ghana, in Africa, for thinking about the rest of the world the way that they might have had the vote gone the other way.
Now, one of the ways the UK's decision to leave might really affect Africa is if it jeopardizes the continent's trade agreements with the European Union. For instance, the East African Community is due to sign an economic partnership agreement with the EU in October. The Kenya Flowers Association is worried that the EPA might not extend easier access to the UK, an important market for Kenyan flowers. Many other regional bodies that have already signed EPAs, such as ECOWAS, will be wondering the same. It will be months and perhaps even years before we know what the actual implications for the UK are in terms of trade agreements with Africa. Although given the relative unimportance of UK-Africa trade, it is highly unlikely that a post-Brexit architecture will look drastically different to what it is today, an assertion which is supported by Professor Sachs.
The European Union vis-a-vis its outside counterparts like West Africa will try to say everything's normal, business as usual. So I think they won't try to disrupt that partnership agreement, and my expectation is that it wouldn't be too calamitous. Now, I'm counting on the fact, for everything I'm saying, that cool heads will prevail, that Britain won't face a kind of dramatic expulsion from Europe now, that trade will remain open, that people will behave themselves so that they treat this in a normal, calm way.
Our stakeholders, world economists and development experts are strategizing to position the country to attain the Sustainable Development Goals. The stakeholders and Professor Jeffrey Sachs are currently in Accra assessing the existing ICT system in the country to make the good vision.
Serving in the capacity of a special advisor to the Secretary General of the United Nations on the MDGs and SDGs, Professor Jeffrey Sachs said attention is on Ghana achieving the set targets. He noted access to education and health in most rural communities in Ghana under the Millennium Villages project have improved, but added Ghana must double efforts to achieve more.
A universally agreed goal. For Ghana, it's within reach, but you have to start running to do it. Economic growth has to be consistently high, and the government has to be investing consistently to help lift the poor out of poverty. Ghana could see 2030 with the end of poverty.
Developing on the lessons of the MDGs, Professor Sachs is of the view that the country can lead in achieving the SDGs with the use of ICT.
We need to incorporate them into our government plans of action, and we need to use technology to achieve these goals.
At a lecture on the goals in Accra, former President Kufuor was optimistic Ghana can attain higher goals.
Professor Jeffrey Sachs, his work on ending poverty, promoting economic growth, fighting hunger and disease, and promoting sustainable environmental practices has taken him to more than 125 countries.
The function was attended by the former Vice President of Uganda, Dr. Speciosa Wandira Kazibwe, and the President of the National House of Chiefs, Professor Na Nabila.
All right, so with the rising uncertainty, investors are coming back to the market. Now, the executive chairman of Australia's second biggest producer is quoted to have said in an interview with Bloomberg earlier today, and specifically on the commodities price and how they've been responding to Brexit over the period. Look at gold, $1,315.19 there. This is the first time gold is dropping in price. An ounce of gold is dropping in price on the world market after Brexit. Now look at cocoa as well. Cocoa has been experiencing a sharp decline for the past 1 week, but today we're talking about an appreciation of 0.67%, which has pushed the price of a ton of cocoa to $3,006 there. Straight quickly to crude oil on the world market, and a barrel of crude oil now is going for $48.18. That's what a barrel of crude oil is trading on the world market, and it tumbled nearly 3% yesterday, with Brent hitting 7-week lows. So this appreciation clearly depicts that there's a lot more to expect in the coming days. But that's it for business this evening. My name is Alfred Kanse.